intraday, I'll sometimes develop trade ideas, and then I'll use MenthorQ to help me zero in. Like I noticed that Palantir was falling a lot today, and that's a stock that I trade a lot of options around, and leaps and covered call leaps, and I use MenthorQ data for that. So today I saw that it was falling, and I have a rule: if something falls 2%, that I start looking at selling puts. And so, I just used my Quinn app, artificial AI app, to look up the Q score for Palantir to see if it would be something that I wanted to sell some puts on today. And I did that with a stock called IREN Limited yesterday. Sold puts and cashed out this morning. So I find Quinn to be a fun little tool, because when you have lots of charts in front of you and there's a lot of things going on, it's super convenient to just have your iPhone in front of you and just look something up. Sorry, you're muted.
Sorry. To add to that, Barry, what you just said is actually pretty cool, because if we look at Palantir today, first you have the Q score here, but whenever you're looking at selling or buying options, you can now use a new model that we presented last week. So if you actually did a great thing, because what this is showing you is the VRP, which stands for volatility risk premium, which is the difference between implied volatility and historical volatility. But just looking at the difference doesn't tell you much. You need to put it in an historical context, and you can see that we are at the 82 percentile over the past 3 months, meaning that the VRP today is 17%, which is almost at the highest level it has been over the past 3 months. So that means that selling options can actually be a better strategy, because you're actually getting higher premium. So you could actually bet on the volatility crash in case that happens.
Yeah, so if you look at the Palantir chart, put support is at 170.
Mm-hmm.
And it's coincident with the 0 DTE put support. So what I would look at is a 30-day expiration, October 24th, 170, which is a 34 delta. It's $6 or $6.75. So I'm gonna, and do I want to own Palantir at 170? Yeah, I'm down with that.
Yeah.
So I'm gonna sell those options right now, those puts. I'm actually selling some spreads and pretty excited about it.
Yep.
Order partially filled.
Nice.
Order filled.
Boom. Live trading. Yeah. So then I'll put a close order in at 40% of the profit.
Yep.
And I just rinse and repeat that kind of a strategy, and it's great.
Yeah.
But I didn't have to think too hard about it, and I have a lot of confidence because we just looked at the Q score. I know that the premiums are great, right? Highly valued. I have a good level to sell at. I mean, normally I would sell a 20 or a 15 delta, but it's great that I have a 30 delta around the put support.
Yeah. And then you could also use the swing. I don't know if you use that, Barry, but you could also use the swing levels to kind of understand the probability of the price respecting that level for the next 30 days. So 20 days is like 20 working days. But so here you have, obviously, the lower band is a bit lower than your level, but there is a 97% success rate over the past 104 days. So
yeah, if let's take a look at this real quick. At the 155, and I'll tell you how I use that exact thing on NVIDIA. But at 155, we have at 152.5, you've got puts that are 250 in premium.
Yeah.
That's awesome.
Yeah.
I mean, so if you have the cash, you can sell a cash secured put for $250, or multiples, and that's a pretty good.
Yeah, and the risk is obviously, of course, there is a risk there. So if, for example, something happens and Palantir goes below that level, then you could get assigned, but at the same time, you're getting assigned $30 off what the price is today. And of course, you need to, when you do these things, you need to be willing to potentially do it on stocks that you like and that so never do it on things that you don't know just because the volatility is high. So that's a big mistake. But like, if you know the business of the company and if you are interested in the company, then you could benefit from the spike in volatility to potentially use options to get leverage and then to get some premium. And if the price drops, then of course you would have bought at 150 anyway, so you get assigned and you're using that. But
Yeah, absolutely. And I like being long that stock, either in the underlying or in leaps.
Yep.
So, equities are different. You have different time horizons. There's a macro picture that for me, there's any of the equities that I hold, it's because of a belief in the macro picture.
Yeah.
And I still don't mind trading around long-term positions. Like, with NVIDIA, I have a super low cost basis. So I'm constantly buying and selling puts and leaps around NVIDIA. And so I use the MenthorQ levels to size my risk in the leaps. So instead of buying the underlying, I will buy leaps and at a 90 deltas, right? So for every dollar that NVIDIA moves, the leap option moves 90% of that. So 90 cents.
Yeah.
And it's more capital efficient. You spend less money, spend less of my trading margin buying those. And then I sell them when they go up, or I sell calls against them. Because I'm willing to be called away after I've made a gain. So those swing levels give me a lot of confidence, on what my expected value is going to be.
Yep. I mean, and also like from here, if you we've done a session on volatility and we can actually do more. So from here, it's important that you look at the score and look at how the option activity. So the score is really a summary of multiple factors. So similar to our hedge fund trade, they would use factor to potentially add value to a strategy, right? So the Q score is doing the same thing. So we are looking at option activity, momentum, volatility, and seasonality, right? So again, we see that we are in a very high kind of like option bullish bias and momentum bullish bias. Overall, our volatility score is low, but the VRP is actually telling us that if we look at the past 3 months, we are actually seeing a big kind of gap between implied volatility and historical volatility. So even though we might be historically in a low volatility environment, we are actually seeing a big gap, which means that the premium that you receive with options are higher than they were, for example, when we were here, right? So if you were to sell option at this point, you would have actually got not enough premium to justify the risk. Right now, we have actually a very, very high, what we call volatility risk premium. And then you can kind of use all the other models to understand where the price could be. So we see the skew, we're in a call bias environment. So the market is actually paying more premium for 25 delta calls, so out of the money calls than puts. So that is also telling you a story. And then, of course, you can kind of see how the option score has performed. So whenever we were dropping here, we would see like kind of like this down move here, and also you can see how the momentum has performed as well. So it's all available for you guys there.
Yeah, that really helps me inform when I want to sell calls
Yeah.
against my leap options. When I get good call premium, especially after when there's an up day, I can sell that call premium, and then next day if there's a retracement, I just buy it back.
Yep. Yep.
So yeah, so really good.
Do you do a zero DTEs option, SPX? No, you don't do much of that, right?
No, I don't. I typically sell MES or ES
Yep.
Options on the actual futures, and I do actually sell a lot of MNQs, especially on really big down days. I might sell a bunch, a couple hundred points below the market, and if I get assigned, then I'm in at a really good price.
Yep.
Markets have a positive skew, so it's okay to be long. After 1,000-point down a couple times in the NQ, that usually ends up pretty good a week later.
Yep. Yep.
I mean, I feel like we're in a buy the dip environment, so that's sized appropriately. That's one of my swing strategies.